Stefan Buchner is the Chief Executive of Euronext. With Mark, you have stock markets in Paris, Brussels, Amsterdam, Lisbon, and now in Dublin. Well, I'm sure I've missed one out somewhere.
No, it's fine.
Right, now, I understand you are just the provider of the market or the vehicle, but what do you make of what we're seeing in terms of this market volatility, this turbulence at the moment?
I would encourage everyone to be calm and cautious and not to overinterpret what is significant but is not enough to be a proper U-turn, especially without commenting too much what happened in US markets, especially about Europe, where the valuation multiples of companies remain lower than in the US, where the prospects of the earnings season seem very positive. So the fundamentals of the companies, of the actual producers of EBITDA and net income are significantly better than when we had last time a significant drop in markets. So I would be cautious in not overmaking it.
And there's one other factor, at least from the European point of view, good growth. Yeah. The best growth in a decade in Europe at the moment.
Yeah, Europe is backed by any standards in terms of GDP growth, but even beyond GDP growth prospects, the confidence indices are better than ever.
How do you prevent, or how does one prevent, if you can, the coupling of the two? Can you decouple European markets from the US? Obviously, if you get a broad-based sell-off, you can't. The two are going to follow each other. But where do you see that coupling at the moment?
Well, the fundamental dynamics of the underlying industrial, commercial, and financial assets in Europe, in particular in continental Europe and in the Republic of Ireland, is much better than they have ever been in the past 10 years. So there is growth to catch now in the continent, in Europe. So I think that will, at the very least, mitigate the contamination, if any.
Do you think there's an entire generation of younger investors who have never seen interest rate, excuse me, who have never seen interest rates above virtually zero, 1 to 2%? Now they're going to start to see 1%, 2%, even 3% in the US. They've never seen markets quite so volatile in the last 10 years. And there is a complacency about markets that we've not seen before.
Yes, to a certain extent. It's a new era, and everyone has to look at the markets with a fresh eye. And definitely, in a context where the situation is changing profoundly in Europe, there is a new set of opportunities.
I need to ask about Brexit, the role of Euronext in the post-Brexit world. Now, obviously, you run markets in all countries that might be looking to take listings, future listings, or even existing listings from London.
Yes, definitely. We run 3 out of the 4 cities that will potentially be the most beneficiaries of the Brexit. We run Dublin in a few weeks' time, Paris and Amsterdam, and definitely we don't run Frankfurt, but 3 of those 4 cities will have more inflows from London. The world as we know it today will not continue. London will not be in the same leadership to finance the continental Europe. So therefore, there will be consequences in trading of euro-denominated assets. There will be consequences in investment banking business moving to the continent. And there will be definitely fewer dual listing and more listing directly in those places.
Right, but in this environment, which is obviously an opportunity for you, are you going out fishing?
Well,
yes.
We don't need to go fishing. We are being fished. I mean, the reality is that the ones who are more concerned about making plans post-Brexit are the ones who need certainty, and they are definitely the ones who are weighting their options in an environment where London is a place of uncertainty more than anything else. So the situation is we have a numerous approach for all sorts of market participants, including issuers, to consider listing in Europe as an alternative to London.
You've been very kind to come and brave the cold tonight.
Thank you.
Thank you very much indeed, Stefan, for joining us.